of Chapter 11 on medium risk choices. So what the first investment option is a mutual fund. So I'll let you write this definition down and then I will show you that video. It's about a little under 5 minutes. Um, it's a group of investments bought using a pool of money from many investors. That's the definition from your book. The combined holdings of a mutual fund are called its portfolio, which we talked about having a portfolio. A mutual fund can have its own portfolio, though. And then investors buy shares in the fund, which represent their part ownership.
A mutual fund is a collective investment that pulls together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can potentially benefit investors in several ways. They are a way to make a diversified investment. Most are managed by financial professionals, and because of the wide variety of mutual funds, they allow investors to participate in a wide variety of investment types. Let's walk through an example of how a mutual fund works. Suppose there's an investor who wants to invest some of his retirement portfolio in the stock market, but he doesn't have time to analyze individual stocks and create a diversified stock portfolio. Instead, he decides that he'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for him? To find the right one, he uses online tools such as mutual fund searches and ratings given by independent third-party organizations to find a mutual fund that meets his investing goals. Once he finds a fund that looks like a good fit, he reviews the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides a variety of information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and other useful information. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So he buys the minimum required investment amount and purchases shares of the mutual fund. By owning shares, the investor now participates in the gains and losses of all companies held in the fund. A benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this can help lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small because that struggling company is only one fraction of the fund's total assets. Like most other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Fund managers aim to provide the biggest returns they can for investors by using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns he was hoping for. However, even if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only costs our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. Now that the investor is bought into a fund, how might he make money from it? One way is through appreciation, which is when the fund's shares go up in value. Typically, when the fund's assets rise in value, the fund's shares do the same. Unlike a stock, the value of a fund's shares does not change throughout the trading day. Instead, the fund's value is calculated and updated when the market closes. Another way an investor might make money through a mutual fund is from a dividend payment, which is when a mutual fund pays out a portion of its earnings to shareholders. However, when the fund's assets fall in value, the fund's shares do the same, which is a risk of owning a mutual fund. One benefit to mutual funds is the variety of mutual funds available. Our investor chose a mutual fund that invested in stocks. However, there's a mutual fund for almost every type of investment. For example, equity funds buy stocks, fixed income funds buy bonds, and balanced funds buy both. Some mutual funds may invest in a whole index, while some others focus on stocks of a certain country or market sector, Certain funds have different objectives as well. Some may look for riskier stocks in growing industries, while others will invest in more stable companies. There's a lot to learn about mutual funds and other investment options. We've got the resources to help you get started. Take a look at more of our award-winning investing education.
Okay, so that should give you an idea on mutual funds. I tried to explain it last period without watching the video and it did not go so well. Basically, though, the idea is your investment is split up. Do not write this down. This was talked about in the video. Mutual funds, they can be convenient, diversified, they're professionally managed, and investment size. You can invest large or small amounts of money. Again, it depends on what each one is looking for, what each company that runs those mutual funds. These are different types that the video also talked about. This is not an all-inclusive list, or they called some of them a little bit differently. But like, for example, a growth fund invests in companies that are expected to grow over the long run. So typically some of those startup grades. And so, no, you don't need to memorize this list. You don't even need to write this list down. If I ask a question in your test, it's open notes. You could just go look it up here. I haven't made your test to know if I'm going to be honest. And it would be something that we've probably talked about. But beyond that, if mutual funds are something that interests you, you would just do some research on the different types and see which one of these kind of stands out to you. Some are riskier than others. And then some mutual funds allow you to do asset allocation, which is choosing a combination of funds within a single mutual fund company. So you don't have to put all of your investment, all of your money into, for example, a bond fund. So in this example, this person's only putting 20% of their money into the bond fund, and then 20% into the growth fund, 20% into the global fund, and you can read the rest of them there. So you can pick the different variety of risks that go with it rather than just all of it in one. Stocks. So again, I know you talked about stocks a little bit with Mrs. Morgan, and you did an activity. I need to go back and look at that to see. I glanced over it, but to see a little bit more because I want to do something on stock as well. But stock is ownership interest in a company. So you own a share of the company, or you have equity in it. There are different types of stocks. So there's a common stock, which is a type of stock that may pay a variable dividend and that gives stockholders or the owners voting rights. And then preferred stock that guarantees dividends but does not provide voting rights. And then there are two ways to make money from stocks. Capital gains is selling the stock for a higher price than you paid for it. Excuse me, sorry. So, but you have anything that you earn there is called a capital gains. But you also want to be careful because sometimes you may end up selling the stock for less than you paid for it. If you think it's going to continue to go down, you might want to sell before it gets too low if you don't think it's going to come back up. Like if you know a company is going bankrupt or out of business or something, keep that in mind. Those are risks. And then another way to make money is through dividends, which we've talked about several times, is money paid, in this case, to stockholders quarterly from a corporation's profit. It doesn't have to be quarterly. I'm not sure why it says quarterly in here. And then there are different types of stocks. So there's a growth stock, income stock, value stocks, blue chip stocks, and defensive stocks. Your book has about 2 sentences on each of these. And if they're something that interests you, you could read into and see what kind of stocks jump out the most to you when you go to invest. Do not write all of this down, please. It's just so you know the different kind of things that are out there. I didn't know a lot of this when I started teaching this class. I still don't know as much as I would like, but I'm a lot more knowledgeable. So there's different, the US, the three main indices are the Dow Jones, the Standard & Poor's 500 or S&P 500, and the NASDAQ. So this is just kind of very brief on what each one is. The Dow Jones is a price weighted average of 30 significant stocks traded on the New York Stock Exchange and NASDAQ. And then S&P 500 is a stock market index based on the market capitalizations of 500 large companies. So if you watch the news or hear something reported on stock markets, it's typically going to be one of these things, if not all three of these. There were some links there, and I did want to open a couple of them to show you real quick. So this is the major world market indices, and you can see kind of the time, how much it's changed. So the Dow Jones, S&P 500, NASDAQ, you can tell these are all in the US based on the flag here and so forth. You can see how every indice is doing. And then same idea here. Like I just wanted to point out, this was from CNN. The top three right up here, Dow, NASDAQ, and S&P. Those are going to be the three things that you hear all the time or frequently if you are doing some research into stocks. And then this is a historical chart of the market indexes. So you can just see this is the Dow Jones Industrial Average from 1900. This is the Dow Jones Transportation Average, and then the Utility Average. And you can see that they've all gone up. S&P, again, you can see how much these have gone up. I did want to scroll down. So commodities also, like you can see, this is gold. The price of gold, I think it starts down here from 1970 to now. You can see how much the cost of gold has kind of skyrocketed. And then this is the US dollar. So the value of the US dollar kind of for other nations. Us, a dollar is a dollar, but if you go somewhere else, you can see way back here in 1984, the value of the dollar was really high. But you can tell now the value of the dollar is kind of on a decline. So a dollar here isn't going to go as far if you go to another country as it would have, excuse me, previously. Let's see. Let me get back to where we were. Okay. So that was kind of those links down there, the main US indices. This next slide is a picture. I like the idea of it, but it does have some typos, so I couldn't edit it. But it just says the importance of the different indices. The stock market indexes are useful in a number of ways to investors. So they give a historical perspective, which I just kind of briefly showed you, but you can go definitely into more detail. And it's also a forecasting tool. It gives you an idea based on the history. Investors can make predictions about what is going to happen. And then the 10 largest stock markets. So before I started teaching this class, I didn't even really know there were different stock markets. I still don't know a ton about it, but I'm a little more educated, like I've said. And maybe you already knew this, but there are different stock markets. So there's the New York Stock Exchange. That's the largest. Japan, the Tokyo Stock Exchange is the second largest. NASDAQ is the third largest, also here in the US. And then you can see each of different countries have their own. Again, you don't need to write this down. It's just for knowledge if the stock market interests you. And if it doesn't, you're a little bit more educated on it. All right, moving on from stocks. So personal residence is what many experts say one of the best investments you will ever make. There are some pros and cons to it. So personal residence is a home that you live in, not buying real estate to rent it out or flip homes, but where you actually live. So the pros in the long run, often the value of your home is growing greater than inflation. And if the value of your house declines, you still have somewhere to live. The cost may be more stable than renting. So you will typically have a fixed mortgage rate now. That means your interest rate isn't changing and your payments are going to be the same every year. Whereas if you rent a home, your landlord can raise the rates. There used to be home loans with variable rates. Those typically don't exist anymore based after a lot of people had their homes foreclosed on in like 2008, 2009. They went to fixed rate mortgages. And then paying rent, some people say it's like flushing money down the toilet because you're paying someone else's mortgage. So that's a pro to owning your own home. And that's also a good tax shelter. You can deduct the interest from your mortgage. If you sell your house, you don't have to pay capital gains tax on the first $250,000 if you're single or $500,000 if you're married. So that a lot of times your income or profit is taxed. If you sell your residence, again, the home you live in, it's different if it's not a home you live in. You don't have to pay taxes on that part of your profit. Some of the cons are it's illiquid. So if you need money fast, you're not going to be able to sell it for full market value quickly. So you can't just put your house on the market today and expect cash in your hand tomorrow to pay something. You could get a home equity loan as an option in there. I'm not saying you should do that. I'm just saying there is a way to get some cash from the value of your home if you have equity in it. And then another con is housing prices can go down. So if you want to avoid a loss on your home, you'd have to wait to sell it. When looking at houses, when you're comparing housing prices and the trends, we often look at the median, not the average or the mean. So you've probably heard this. You don't need to, this whole chart, there's a lot going on. You've probably heard the term mean, median, and mode. I'm sure all of you have, you may not remember them. So the mean is the average, add them all up, divide by how many there are. We just did that last week. The median is the middle value. So if you put list from smallest to largest, it's what one is in the very middle. Mode, just for reference, is the most popular, most common number in a list. So when we're looking at houses, we talk about the median because then the median isn't as affected by outliers. So if there's one house that's worth a lot or not worth a lot, that's not going to affect the median the way that mean would be affected. So this is a little outdated. It only goes to 2016, but this is home sale prices by year. So it compares San Francisco in the black, California median, and then the US median in that purplish reddish color, maroon maybe, yellow in the middle. So you can see how much more it costs to live in San Francisco than California as a whole, as well as you can see California as a whole costs more to live in than the US. And where the US goes up right around 2006, so does California, so does San Francisco. They just go up even more. And then this is, so price depends on location, which we already saw. You can see it here a little bit more localized. These are by county, also goes to 2016. I'm not sure why Solano County is not on here for these Bay Area home prices. But you can see down Contra Costa and Sonoma County are the most affordable. San Francisco is the most expensive, with San Mateo right behind it. Marin County back in 2007, 2008, even before that, was the most expensive.
On my hand.
What? An owie?
Yeah.
Okay.
It's really hurt. Can you put this old band-aid on me to make it feel better?
Yeah.
Right there.
Okay. How'd you get that owie?
From a big truck.
Throw this away, please.
From a big fire truck.
Oh, here, throw this away, please. Sorry. So now we're going to talk about retirement accounts, because retirement accounts are considered, these ones, medium risk in options. So an individual retirement account is an IRA. A traditional IRA is contributions are tax deductible and grow tax deferred. So you will pay taxes when you withdraw the money, which we've talked about often in retirement. You're going to be in a lower tax bracket because you're not making as much money. Whereas a Roth IRA is an individual retirement account in which contributions are taxed, but earnings are not. So when you get this money, taxes are taken out right away, and then it goes into your IRA, into your account, and it starts earning money, hopefully. And when you pull that money out, you're not going to be taxed again. You already paid the taxes up front. However, with these accounts, I believe both of them, I know you have to be at least like 59 and a half before you can start taking money out of them without being penalized, because they are for retirement. A Keogh plan is another tax deferred retirement plan for self-employed individuals and their employees. All the contributions come from the employer, not the employee, and contributions are tax deductible and grow tax deferred. So if you are interested in owning your own business or being self-employed, this is something that may interest you and you would want to look into. Hold on. Your dad's at work, baby. Okay, and then also a simplified employee pension plan is a tax-deferred retirement plan for small business owners and their employees. So again, if you're going to own a small business and have or be an employee of a small business, this is something that may interest you, or a route you may go, I should say. Retirement plans available through employers. So there are benefit plans. So we talked about this a long time ago when we were back at the beginning talking chapter 2, I think, talking about comparing options of job offers. And one of them was part of the benefit package and looking at the retirement. So part of the retirement could be part of a benefit there. So there's a pension plan. It's an employer-sponsored retirement plan where workers receive a guaranteed monthly amount upon retirement based on wages earned and the number of years of service.
My chocolate milk's all gone.
So workers must be vested in the plan by working a certain number of years. Not many employers offer them because they must make the guaranteed monthly payment amount even if the investments are doing poorly. We're not going to look at these links. There actually is, part of your homework tonight is an article saying what is a pension plan. It is not very long. Please read that before tomorrow, because tomorrow we're going to look at different types of retirement accounts. one of the reasons I'm not going into these too much. But for a pension plan, you must be vested, and that means you have to be there a certain number of years, and different companies have different amounts of time. Teachers often get pensions, law enforcement, firefighters, those are often careers that have pensions. So some careers will typically offer a pension plan. And then there's also where you receive a monthly amount upon retirement based on what is put into it. So there is a 401k and a 403b. So the amount of money received monthly depends on how much money you have and how much it gains and loses. So 401k is tax deferred retirement plan for employees offered by businesses that operate for a profit. So when you get your career, if you're working for a company that operates for a profit, their goal is to make money, then you could set up a 401k. A 403b is very similar, but it's for employees of schools, government units, and nonprofit organizations. And then matching, this is part of the benefit package that we talked about briefly before. So employers offering a 401k and 403b plan may offer to match your contribution. So for example, if the employee saves 5% of the paycheck every month, the employer will also put 5% into the retirement fund for you. So that's considered free money, and you always want to max out the match. It could be 5%, it could be 3%, it could be a dollar amount like $100 a month. You always want to match whatever they are willing to put in.
Mommy,
Yes.
look what the table looks like.
Oh, cool. And last slide for today.
I want to show you what it looks like all the way.
So your retirement plans, most of them are portable, meaning you can take them with you if you leave a job. A rollover is the process of moving a retirement account balance to another qualified account without incurring a tax penalty. So if you leave a job, you want to take your career, you want to take your money with you. Make sure you are vested so you don't lose your investments before you move jobs. So for example, if you're vested after 10 years and leave after 9 years, you're not vested yet then. So the money that your employer puts into your retirement account, you don't get to take that with you if you're not vested. Once you're vested, that's your money. So if you're unhappy at a job, but you're close to being vested, it might be worth sticking it out so that you can get that essential free money. The money you put in, you get to take, yes, but you would also get to take the money that your employer put in. So that is the last slide for today. Tomorrow, we are going to look at types of retirement accounts and possibly something on stocks. Please read that article before tomorrow. It is not very long. When I printed it, it does print onto 3 pages, but the font is big. It is not lengthy at all. It should take, I'm going to say 5 to 7 minutes to read it maybe. And since class is so short, please make time to do that. But you guys are free to go.